Before we continue, I wish to discuss about the company's net asset. A company has assets like buildings, vehicles, production facilities, or cash. Its assets could be like what I said above. So the companies does have some assets lying around, and these assets are owned by the company. And similarly, the companies has liabilities. These liabilities could be cash owed to the bank, cash owed to suppliers. Let us assume that if we were to liquidate this company, and what we mean by liquidate, we mean that we are going to sell off all the assets of the company, turn them into cash, and we're going to take those cash to pay off the company's liabilities. What's left over belongs to the shareholder. And the leftover amount is called the book value over here. Like so, the book value. And there are also other names for book value. The book value can also be called net asset value, equity, accounting value. So all these means the same thing. It's really funny how in the financial world, people like to come up with different names for the same thing. But don't worry, net asset, book value, equity, accounting value, all mean exactly the same thing. It's simply asset minus liability. This is a very important concept. In this section, now that you know what is book value, let us talk about the price to book formula. We already know that earnings makes a company valuable. The next question is, what else makes a company valuable? What makes it such that investors on the stock market are willing to pay for a company? As a shareholder, the company that you own have assets. This asset, after deducting its liabilities, belongs to you as a shareholder. This is known as the net asset value, or the book value, or the accounting value, or equity. Don't worry about these different terms. As I discussed in the previous slide, they actually mean the same thing. The book value has value, and the stock market is going to assign a certain valuation to these assets depending on how much they think they are worth. They feel this net asset value is worth more than what is written on the company's balance sheet. They will be willing to pay more for it, and the company is more valuable. If they feel that the net asset is worth less than what the accountants in the company say they are worth, they of course will be willing to pay less, and the company becomes less valuable. So the next question on our mind is, how do we know how much these investors are willing to pay to have an ownership of the company given the company's current net asset value or the book value? This can be very easily determined by the market price. The market price tells us right now what investors out there are thinking. It tells us how much and how willing they are willing to pay for those net assets. A high price relative to net asset tells us that investors are very willing to pay for those assets. They think it's worth more than what is written. A low price relative to the earnings, a low price relative to the asset tells us that investors are unwilling to pay for the assets. If investors assign a low price, we need to question whether or not the company is really worth such low prices. Maybe the investors are wrong and prices should be higher. If they are wrong, we can actually make money from their mistakes by simply buying the shares and wait for the price to appreciate and sell for value. Alright, so we previously discussed about book value, and then we discussed about market value over here. The book value is the net asset of the company, which means the asset minus away the liabilities, because the company needs to pay for these liabilities in the event of liquidation. And the market value is what the market thinks the price of the asset is worth now. Let's now discuss how we can compare these two numbers to form our price to book ratio. The assets of the company act as a backstop against drop in price. Just think about it. Let's pretend the company doesn't make or lose any money. It has 20 million of net asset, and most of these assets are in cash. So if you buy the company, you are effectively buying the company's net asset. If you only pay 5 million for this 20 million of net asset, don't you think it's a good deal? It's effectively getting free money on the table. It's effectively free money on the table, right? So that's why we love this valuation ratio so much. It allows us to determine whether we are getting a good deal relative to the company's assets. So that's the whole idea behind using book value, using price to book ratio for this method. Price to book ratio allows us to compare what we are paying for compared to how much assets the company has. The less we are paying for and the more assets the company has, the better safety net we have.